Now I'd like to talk about our theme, which is resilience, and which is defined as the capacity to recover quickly. And we developed this theme while we were looking at some of our company's earnings reports over the summer. And I was actually very impressed and to be honest, somewhat surprised when I looked at some of the results and I saw how steady they were given the severity of the virus and the recession. One company we own in the Fan Value Fund is in the semiconductor industry, and they reported their results in August. And those results were for their third quarter, which was May, June, July of this year, which was a very difficult time for business globally. And their earnings per share were down a little, not much, and the cash profits in the business were actually up slightly for those 3 months. And I certainly thought that that was very resilient and good results in a difficult environment. One of the reasons that we think many of our companies have that resilience is our selection process. As Tom mentioned in the video, we're focused on investing in quality companies. So what does that mean? We think quality companies are ones that are financially strong, they have little or no debt, they generate cash profits, they grow over time, and they have very high returns on what we call invested capital, which is a measure of profitability. In addition to these financial metrics, we also think that these companies are well managed. We spend a considerable amount of time focusing on the management of the businesses that we own. Historically, meeting with managements in person, which we'll do again, but this year, doing a lot of Zoom meetings and phone calls and staying in touch with our management teams. We continue to look for managements that are both honest and have skill at running the business, and we need both of those components. So certainly, it's been a challenging year, and we continue to face challenges with the virus. We're in the midst of recession, and certainly in the election coming up in a few weeks. But we will do our best to stay resilient and to invest in resilient companies that can do well in any environment.
Absolutely. We appreciate the question. It's a favorite subject. Kind of the joke around here is we were ESG before the term had been coined. I mean, going back to the 1970s, we've been thinking about these issues. We spent a lot of time talking about it as a group. Sometimes it's really simple. Many times it's actually complicated. So we like to really think it through, talk about it. Just to give you some examples, we're going with the E, S, and G. Environmental, sometimes we run into a company that owns coal plants, perhaps, if you're looking at a utility. And regardless of what my opinion is or isn't, the coal plant probably isn't going to get its charter renewed by the government when it comes up in a few years. We try to avoid those kind of things. We look at companies that deal with chemicals. If they've got a history of spills and EPA fines, we just don't want any part of that. On the social side, we always talk about we want great companies, quality companies. We throw those terms around, and really, if you cut through it all, you can't have a great company when you treat your employees poorly, you're taking advantage of your customers, you're doing something that's bad for your community. I mean, all these things are factor into those great cultures, these great companies we look for. So we talk about that stuff a lot of the soft issues, they call it. And then governance, to really sum it up is the incentives and the structure set up where the insiders are going to make a ton of money, even if shareholders don't make any money. We have no problem with CEOs and CFOs and all those folks making a lot of money, but we need to make money as well. It needs to be a reasonable amount of money that they're making, and it just needs to be, the incentives need to be aligned with our interests. So we do spend a lot of time on this. Sometimes it's just a friendly phone call. I mean, as we've pointed out many times over the years, we tend to know our management teams really well, and a lot of times you probably just call them friendships. So sometimes we'll call and say, hey, look, it's kind of egregious. That's a lot of money. Or, hey, I understand why you do this, but we'd love it if you put a return on invested capital part in here to your compensation system. Occasionally, we will publicly vote our proxies, which is when all shareholders get to vote on these issues. and vote against what management wants, which is a sure way to get a phone call from management to have a good discussion. So, this is something we've always taken very, very seriously. It's tricky, it's complicated, but we think we do a pretty good job on it. And we're always learning, trying to get a little bit better.
As I mentioned in my opening comments, there is a lot of uncertainty. We've been through a lot of uncertainty this year already. And we wrote in the semi-annual letter for the value fund about, basically it's impossible to predict the future. So you need to make investments that will do well no matter what happens. And I think that's how we try and manage risk. So the two things that we can control are the quality of the businesses that we invest in. And that includes what is their financial profile, debt, cash generation, returns on capital, and how strong, how good is management. So we can control the quality of the businesses that we buy, and then we can control the price we pay for them or the price we hold them at. And if they get very, very, very expensive, there's a chance if the market goes down or if you have some volatility that those stocks can go down a significant amount. So the way we manage risk is to make sure we're buying a quality business and make sure we're not paying too much, and then just to continue to monitor those two aspects. Because we know, Andrew mentioned being humble, we know that we don't know, and so owning the best companies will help us get through whatever the environment is.